Good evening to all of you. Welcome to today's webinar. Today we are going to look at whether we should. There is always a debate whether we should more look towards fundamental type style of investment, or we should follow technicals. So it depends on each one's comfort. Normally, fundamentals are used more for investment, but a clear understanding of fundamentals is also very much required so that you don't rush into a certain type of technical trading. One. For analysis, you should be careful with your stop losses, because if the price already is at a lower level, that is, if the valuations, I would say, is at a lower level, then probably you can be a little bit liberal about stop loss, because even if it goes down, it can come up. So to a very large extent, the fundamentals will also help you to understand whether this market is a trading market or whether this is an investment market. So to that extent, you can use your chart. Now, for example, some stocks, mid-cap stocks, we're always talking about very high valuations, something like 50p and above 50p, 70, 80p also. So in those stocks, even if the company is doing well, it is not at the right price. So the business may be correct, the company has a good governance, but the price is high. So we cannot buy a stock, even if it is a good quality, at a high price. This is what we have been emphasizing. Suppose, in some cases in a bull market, for a stretched period, you may see the stocks going up, but at the same time, you will always be jittery, because you will always be thinking the valuation is very high, and probably you will be missing a considerable portion of the rally. So to prevent that or to preempt that, what you do is, okay, you understand that it is highly valued, either you can ignore and wait. So sometimes by ignoring it, probably our portfolio can suffer. So what best you can do then is, okay, I understand that this market or this particular stock is valued high. So in that particular case, I will trail my investment with some stop losses. So that way, that at that point of time, you can use your technical stop losses also. So that is what we are going to see today. Because sometimes for a very longer period of time, the markets are capable of confusing you to the extent to accept the valuation at that point of time. But only to see that what we thought about this company or this particular stock or whatever, that valuation is so high, may prove to be true after some long period of time also. We have seen many stocks right now in large and mid cap side, particularly the mid cap and small cap side. But even in large cap, a lot of stocks now are correcting to what valuations we pursued at that point of time, because there must be some correlation to its growth, present growth, historical growth, and the last few years and quarters growth, and probably give something for the likely perception of how this company can grow over a period of time. See, in the case of Nifty, most of the large cap stocks are stable stocks. They are not really growth stocks, because already most of the stocks which are included in the Nifty or can be classified only as stable stocks or value stocks. The growth stocks, now some stocks have been added, but we do not know whether that particular growth is likely, which the valuation is giving, is likely to materialize or not. Now, we have seen in the case of fundamentals, what are the ratios that to use. Maybe the price earnings ratio is one, price to book value, then enterprise value to EBITDA. So these are common ratios being used, but there also you cannot use absolutely, because you will always feel that the market PE ratio and other things, probably you do not know what is the right PE. So that is the problem. That is what the market gives. But assuming I say you use PE ratio or price to book value, then in that case you do not know how do you judge that what is the right price to earnings ratio that is given. This is a problem for any big investors or fund managers also, because everybody can go wrong. To that extent, probably some calibration along with technicals will definitely help to give some deeper understanding of the market and its investment. For example, let us say whatever investments you are going to say or see today is not a reflection of any personal opinion about that particular stock, whether it should trade at this level or not. But what we are trying to highlight is, see this valuation, see the profit growth, and then decide for yourself whether such valuations are there to be given or not. Now, we will take from some big large cap IT stock itself to show, for example, TCS. Now, TCS, if you see, it is all growing at something like 7 to 8% or 9%. Approximately, I'm saying, I'm not going exactly into the specifics. But what is the P ratio that is being given is about 30. Okay. Now, if you look at it, you will wonder as to why is this stock, when it is growing at 7, 8, should be given a P of 30. Now, the first thing that you can try to understand is you compare that with Indian stocks and put a median. Now, stocks which are like TCS, maybe Infosys, Wipro, Tech Mahindra, these type of stocks, you look at it and probably look at their P ratio and then see whether this is trading above the industry median or its peers. That is one. Second thing, you also look at global peers. Now, global peers probably could be Cognizant, Accenture, like that. So, for this particular profit growth, what is the P being given there? So, that is the right thing, because Indian tech companies are also almost global only, because most of the revenues are global revenues. In the case, why this company should alone get such a high valuation? Probably there are other reasons which may be linked to the Indian market and to the specific company reasons. For example, TCS may have very high promoter holding. Probably the return on equity is good. Probably the dividend, some extra dividend, special dividends which come out could be a little bit attractive. Probably the quality, the number of Indian stocks available may be limited. These are could be reasons why probably we command a very high premium compared to global peers, because even companies like Microsoft may be growing at 15-16%, maybe having 32, 33 PE. But a company which is growing at less than 50% of Microsoft growth commands high valuation. So this is globally. Similarly, you look at the banks here also. Some of the private banks today are almost double the valuation of the private banks in US. So this is something which is slightly common in India, but we should always be upfront that these valuations, whether it is sustainable or not. So because most of the times you see those valuations after an extended period of time, they are not sustainable and they come down. Now, a lot of these valuations, for example, if you see in a big cap, even large cap, I will show you how the valuations keep coming down. I'm not reflecting about the price alone. Maruti. So these are all at one stage were very highly valued. Probably this had a PE of even 100. Okay, and Maruti also had a PE of 80. So these things happen, but now I think this has settled slightly at much reasonable level for its growth. And Asian Paints. Still at commanding a much higher valuation compared to its normal growth. So there are different types of analysis which is being done, and the most important analysis that is being done is the DCF, which is earnings based or dividends based. So this is a very conventional fundamental analysis of discounted cash flow. So this is one way to understand the market. Second thing is to understand the relative value, because the DCF may tell you that see, the price is for Asian Paints, let us say for example, is only 1000. That is based on its present growth. It is growing at 14-15% over a period of 10 years. And if you put a cash flow and do that, I think with all this book value added, probably it could show the DCF is only 1000. But for long period of time, it might not have traded closer to DCF itself. It may be only trading much above the DCF value, much above the DCF value. So we can know probably to what extent this goes above the DCF value. That is one. On a relative basis, that is over a period of time. DCF, suppose if it says 1000 and if it trades 2500, so we know the peak of the particular stock almost it's almost 2 to 2.5 times the DCF. So it's a very curious thing that normally it should not happen to that extent. It should relatively trade somewhere some percentage points above its DCF. But to trade at 2.5 times means there is a chance that probably a pullback can come fast. Now, No, the relative value tells you that compared to its past valuations, that is the PE at which it has traded, the price to book value it has traded, and also the enterprise value to EBITDA it has traded, and also compare it with peers. So some the analysts come to a conclusion what is the relative value, because the DCF earnings base could be much lower, the relative value can be much higher. Okay. So what they do is that, okay, on relative value basis, probably the stock is fairly valued or underpriced, but compared to the earnings estimate or dividends estimate of the discounted cash flow, the price has run up too high. So what they do is they try to take some midpoint between these two and then come to, so because everything there here also in the quantitative analysis also, certain things are judgmental. You cannot, because if you look at people analyzing a particular stock, some people will give a different fair value, some people will give another value. So these things really will be confusing, but to some extent we can understand that yes, this price is too high above the fair value even on a relative basis, or probably too high only on a DCF basis, okay, or could be both. So in that particular case, what you should do is that you should look towards probably disinvesting your existing investment, one. And at the same time, you should also look towards putting stop losses, trading stop losses, which you can study to probably through the graphs which you have already seen, or statistically, to what extent if it falls below, then you should cut off your position. Okay. So normally in the indices, it's a different ratio. Probably in the stocks, it's much more volatile. So if the index goes down by 5%, some of the stock can as well go down by 10% or so. So we should know where to put our stop losses in this particular case. So we are talking from a micro level, not from the macro level of interest rates and other things affecting. We are just talking about each individual company's valuation. Now, because the entire macro thing comprises of the sum amount of the microeconomics. Now, so this is one understanding. So now we will look at the same script which we just talked about, TCS for example. Let us say, now this is the let us say PE ratio chart, and let's look at the if you look at the 10-year thing, it is 26.5. It is 26.5 is the 10-year median, and also the last 3 years almost the low is only 26.5. Since 22 September, I think it has not fallen much below the 26.5. So 26.5 seems to be the one which is holding, and it's a 10-year median thing. And so the PE ratio came down to 27.5, not even to 26.5. So to some extent we will know that the relative fair valuation for this stock on a long-term basis is around 26.5. But considering when the market is quite bullish, it never comes much below 27 or 28. Now, if you feel that the market is bearish now in the present case, probably you should value the stock as 26 or 27. Now, even at this point, this is a relative value basis. But if you go only with the DCF earning based, this one, then probably TCS may not even qualify for a 1,200 rupees stock. I'm just saying that because the growth pattern, if you put, and longer period of time also, if you put the same growth, maybe the DCF will say it is only 1,200, 1,300. But we cannot go only on that basis. So we have to look at certain other parameters, which could be probably in this case a price to earnings ratio, which is 26.5. Now, if it is already, let us say the present thing is 134.78 is the last TTM EPS, that is last 12 months trading EPS. So approximately 135 into 27, I'm saying approximately, puts it around 3,645, around the 3,645 to 3,700, where on a relative basis, probably this stock could be okay. Now, this stock although has gone up to 4,500 and around at 3,700, 800 points of fall will be something closer to the 20%, 18 to 20%, which probably could be a level from where it could bounce, because we have already said that most of these stocks really get down up to 25% large cap stocks and then start to rally. Not always, but most of the times. And in the last few periods of correction also, TCS has not gone down much below 25%. For example, in this particular case also, from approximately 4,000 to 3,000, which is around 25%. And in this particular case, it's a pandemic time, so we'll leave that. and in this particular case, so 1419 to 1025, approximately 400 rupees, which is around this 25%, less than 30%. So 25 to 30% is a normal correction. So 25% correction in this particular case also could mean something like 1,200, 1,300 points, which could be 3,200. I think no, if you put 4,500 into 0.75, it comes to 3,400. So 3,400 is where it is showing. Now I have put a 3-month chart. Now let us say this particular thing is a 3-month quarterly chart. Now in the quarterly chart, if you look at it, there is now this is one low, this is another low, this is another low. So probably on a quarterly basis, the stop loss comes 3,600. So mostly there is a chance that it could come closer to 3,600 and bounce back. So 3,600 in this particular case could be on a, now we are evaluating on a technical basis. So on the technical basis, 3,600 is okay, and from the Fibonacci ratio also, if you look at it, now we'll go from this, from the pandemic time. Now this corrected 38.2%, so this has slightly gone up. So this is the 23.5% from the pandemic low. If you look at from the pandemic low, it is 3,849, and if that is broken, then probably there is a chance that it could come to 3,400. So the Fibonacci tells you that probably up to 3,400, which is around 1,100 points. So 1,100 divided by 4,500 comes to 25%. So this is where it has happened. So the possibility that it could go right up to 3,400 cannot be ruled out. 3,400 cannot be ruled out. And also what we have seen, if you look at it in the case of TCS, the last thing is approximately, if you look at it, this is the 1, 2, 3, 4 quarters, right? So the price goes was 3,591 and 4,592. So it's almost 1,000 rupees. So 1,000 rupees is the normal, looks like 1,000 rupees is a high to low for a particular year. So here also, if you look at it, this particular one, it is 3,250 and it is 4,250. So 1,000 points. So from every other quarter, it makes a 1,000 points movement. And if that be the case, then in this particular case, it has already moved. See, in this case, it was 3,591. And already in this, for the instead of the full year, it has already moved down up to 4,592, leaving very little possibility for these 2 quarters. So for the already 3rd quarter is over, so 4th quarter is there. Now let us say for the next 2 quarters, if you want to know what is a 1,000 point. Now this is 4,592. It is 4,592. So either it has to, if the low of 3,884 has to hold, then probably we should see a 4,884. Okay, 4,884 the next 1, 2, 3 in the next quarter or so. We should get that. But whether we will get it or not, we don't know. So from this, from the that is till April, May, June, till June we are talking. Before June, either it has to go to 4,884, or probably before June it may fall to 3,500 to 3,400. So closer to that, either we are talking about a move, either it could be 4,880 or it could be talking about 3,550, 360. Now we have to make a judgment as to where the market stands now. So what is the possibility that probably it can get pulled down by further down by another 500, 600 points on this side, and if there is going to be a rally, probably we could see something like till June we could see 4,882 is a possibility. So we need to see whether how this particular this one. Suppose let us say if we feel that this is the low, this is the high. Till such time 4,322 is not broken, we can say, because the reason we are saying 4,322 is that you look at it. Okay, now this is a month low, this is a month high. Okay, 4,494. Now what this is also if since it is 4,494, this particular month low, if it is broken, that is 4032 is broken in a significant manner. Already it is close to that. If 4032 is broken, then we are seeing a lower top on a monthly chart, which is not good. Which means that in the next 8-9 months possibly, we could see something like 3.5. We could see something like a 3.5. So I would, in the present circumstances, considering its valuation, suppose if it comes to 3.5 or 3.6, and the stock also grows to some extent, divided by even 137 or 138, it would come to 26.5. which is what I feel is a 10-year median and at a reasonable level. So now from fundamental and technical point, I would say that no wait for TCS closer to the 3-5 levels. Now, where will I change how will I change my attitude? Now, I have to now look at whether this stock is capable of breaking this particular trend line. Now, so this is the trend line, right? So till such time this trend line is broken, say next month, now January is getting over almost, 4424. So it has to break 4424 for me to go on the higher side and call for a 5,000 in the next 8-9 months, 10 months or so. If that be the case, then I will, if 4424 is broken, I will keep this low or probably this low of 3913 and call for a 5,000 levels if that is, in the next 8-9 months, if this particular thing is broken, right? If this is broken, that is 4424 is broken. Till such time 4424 is not broken, I would call for a 3536 levels. I would call for a 3536 because TCS moves by at least the 1,000 points, and that's the volatility of TCS also 23-25%. So that's the volatility of the of this particular stock. So probably we could head towards that particular level if things don't work out. So now we have combined our fundamentals and technicals as far as TCS is concerned. A 10-year median PE is what we are looking at in a bearish scenario, and many times whenever there is a dip, it has come down to 27.5 in the recent periods. So let us see probably this time whether because of certain reasons it comes closer to 27.5 or 26.5. Right now it's still at 30, which means a 10% correction is still possible as far as TCS. I am not saying that it is, but it is possible. So we have to be cautious. So in that case, we should put our thing with a clear technical stop losses and trade this particular market. Now, same thing. Let us look at another stock, a large cap stock itself, Reliance. Now, what happened before and right now? Reliance Industries. Now, Reliance Industries, 5-year PE averages 26.4, right? So now it is already below that. So you can see 5-year median, it has crossed below the 5-year median. And 10-year median is 21.5, 21.5. And in the last few years, the low that it has touched is this, that is 21.6. So it has come closer to 21.6, and right now the stock has a EPS which is 51.13. So 51 into this low which came in March 23. If this is going to be revisited, then 51 into or 51.5 into 21.5, 1107. 1107 is a possibility. So 1107. 1100 is a distinct possibility, and if you look at the that is the discounted cash flow, okay, then also in that particular case, if you are looking at Reliance also, last 3 to 5 years it might have grown, but over the period of time, I think Reliance growth also, let us say CAGR, growth CAGR, compounded profit growth in the last years is 16, but last TTM is -1. So last 10 years is 13%. So most of the top stocks have grown only at 13% over a period of time. And last 3 years, if you see that the stock, the stock price growth always that we have seen, over a period of time should not exceed more than 1.5 times of the profit growth. That is what happens in most of the stocks. So we should not try to be too this one. And so now this is coming, let us say the last 5 years it has come down. Last 3 years because of the pandemic thing it is working out. So now this last TTM is -1%. And if this is to be the trend, the last 10 years growth, if it is going to be 0%, then in that case, you subtract some 13% and then add the 0. Then in that case particularly it can come down by 1.2 to 1.3% down, which means the entire thing will be instead of 13 it could be 11.7 or so. So 11.7 into 1.5, if you put it, it should be 17.5% maximum stock price growth. Yes, so 17.5% stock price growth over a period of 10 years, okay, should be the growth over a period of time. So that is where probably we could put this particular Reliance and call for its I or so, right? So whenever the stock price goes to that particular level, then in that case it becomes an exit. It becomes an exit, and whenever it comes much lower, probably like 1100, where it comes closer to the PE of long-term median PE, then it is a workable proposition for us. Now let us look at the Reliance from the chart angle now. Now let's say Reliance. Now on a monthly chart, definitely this is down, and this time again it tried to go up but couldn't go down, and so the next level of support comes closer to the 1110. So this is what we said. So 1110 becomes a important place for a thing, and we saw that this particular being resisted 1315, and that is what has happened. So 1329, if you look at it, 1325, 1326. So this is also 1296. So this is slightly higher. So this particular one is getting resisted at this particular level. So good chance that now we could look from the pandemic low. What is the correction possibility? Now this time the correction was 38.2%, and so 1134. So I think probably we are moving towards the 1134 to 1140. So that is what we said. Probably the resistance will come closer to the 1142 levels. So I think 1142, 1120, 1140, technically it looks to be that, and at 1120, 1140 this comes closer to 21.5%, and that is where probably, so now we are trying to come now, so it is still at it is at 1229. So I think probably it's time for us, at any rally it comes, probably we should exit and wait for a fall closer to 1130, 1140 to again look towards investment long. Now this particular stock also, if you look at it, this has chance of going up to, in a year it goes up above something like 400 points. Right now 400 points is what we are looking at it, and so if this comes closer to 1608, so maybe the 1208, 1, 2, 3, 4, 5, 6, 7 already. So already it came closer to 1200. So 7 months. Probably the next couple of months we may see this time it is slightly exceeding and pushes itself towards the 1130, 1140 levels, because the volatility might have increased to some extent right now. And in the previous period and all, if you look at it, this 3 months thing will put down. So here if you look at it, 1, 2, 3, 4, approximately it moved from 1000 to 1315. That's what I'm saying, 373, 80 points. Maybe that time 373 it was around 37, 38%. Okay, for this movement it was 37, 38%. So we can't talk about 37 as a percentage there, but we can look at it from this angle of around 350, 330 points. But probably already it has come down much lower than that. So 1608, 315, 330 probably will be looking only at some 1270 levels. So it has already come down much below. So we expect that probably it could even move right down up to 1140. And in this particular case, if you see the year, from here if you look at it, 1110 to 1608. So in this particular, for this one, it was almost 500 points. So sometimes it is 315, sometimes it is 500 points movement that is taking place. So on an average it moves around by 400 points. So the 400 points, it has come to some rest right now, but probably there is a chance that the extreme amount is 500 points. So the 1608 probably could swing back down up to 1500, 1508. And Reliance also has a volatility which is closer to the 23, 24% thing. So here also we may see a possibility which could be around 1600 into 24%, which is around the 400 points. So around 400 points is a possibility. And here also if you see the market, whenever it moved from here, it was 830 to 1248. So on this one basis it was 450 points. So on average it means something 400 to 450 points is what no, on an absolute basis it moves. Okay, on an absolute basis it moves. So 400 450 points is where we have also seen in this particular 4 quarters also, 1 2 3 4 quarters also. And here if you see this was a slightly depressed one, 1296 to 989, something like 300 points. 300 points is a minimum, I think it comes, and it stretches up to 500. So on average we keep 400, and probably at the maximum it would be 500. So the next couple of months, if you see 1100, there is a good chance that it can start moving up again, because right now we see it coming closer to 183. So 183 for a 3 months figure. For this is around 120, so 116 into approximately 3.46, so around 400 points normally. So it has already come to 400. Probably if it exceeds, it could go by up to 500. So 1100 probably could look to be the area where from where Reliance can bounce back. Now we have seen the technicals. We have seen how the PE ratio. So we are not taking too many things. We are only taking the PE ratio. And if you look at the DCF, probably it could be 11. It could be around 1200 level. So on a DCF earnings basis, I think Reliance is okay for its for the normal growth, which the 13% growth. It had over a period of 10 years. If you take over a 10 years period. But the question of forecast, whether this stock is going to grow at 13% from now, or the stock is growing at 7-8% from now. So that's a judgment probably the market will be looking at it, because past history is one and future is one. Suppose if it is going to come down to 13, from 13 it is going to drop to 10. Then in that case the valuation also has to drop significantly, because at 13% growth to 10% growth means around approximately 20-25% drop. So the valuation here also should, the PE ratio can even drop from the present level of 24 to less than 20, 19 or 20. So that is where we need to be quite careful about this particular stock. To what extent probably they will drive down the stock depending on the future this one, and because if the growth comes down, then the PE ratio also has to adjust to if it remains still high, then we call for higher valuation, which means the stock is not good to be worth to be invested, because you cannot keep switching a high valuation for a low growth for a low earning stock, okay, unless you feel that this stock holds great potential for future. Now Reliance and all has stabilized to a very large extent, so a lot of their projects and things are known to. So if the growth tapers off, I'm sure that the PE valuation also will drop accordingly, and we need to be careful and price this at a much lower valuation than what it is even now. So getting it to 21.5 or even getting it much lower to that, I think is something which has to be seen. Suppose if you put in a growth rate from here, which is not 10%, 13%, which is there, and if you put it something like 8 to 9%, the stock will have a much lower, should go for a much lower valuation. So we have to be very careful about it. And this is evident even in large, if you look at the mid-cap stocks. Now, let us say some of the mid-cap stocks which have done very well as far as the performance is concerned. But look at the valuations and why it is coming down. Now, for example, one of the good stocks is CDSL. Today, the price is 1344 and it is down 10%. It is down 10%. So, let's see. See, if you look at the pros, company has reduced debt, company is almost debt free. It is expected to give good quarter results, has delivered good profit growth of 30% CAGR over the last 5 years. So 30% CAGR is there. And company has good return on equity, around 29%, healthy dividend of 58.3%, medium sales growth of 18.5%. Stock, but only thing is the stock is trading at 18.4 times of its book value. So that is where probably the problem comes. It's a slightly richly valued stock. But even now, if you see, the PE has come down closer to 50.60. So 1300 divided by 50.60 with an EPS of around 25.6. So the net profit growth, if you look at it, So in December 2024, now it has come. So the profit before tax is 168, and December 23 was 145. So on a yearly basis, if you see, the growth has slightly tapered off. It is only 16% growth. So the market has a little now got a little worried, because previously, if you look at it, December 22 to 23, it was 19 to 145. It was a 45% growth. Okay, from December 22 to December 23. But from December 23 to December 24, the profit has tapered off, and it is reflecting only 20% growth, because it was post tax. It was 107 December 20. Now it is 130 23. So almost 22% growth only after post tax. So it's worried that probably we should whether over a period of time the growth will come down to 20% or 25%. So long term growth cannot be more than 20%, because it cannot, nothing can sustain about 20%. So when you are trading a high valued stock which is 50, and when it was around 40, 30, 40 and all, it was at 50. Okay, now if it's going to come to 20, then in that place the valuation has to drop down to around 30 or so. But profit may still grow, maybe 20-25% growth may be there. But if the PE is going to get adjusted from 50 to 30 over a period of time, it itself signifies another 40% drop. Okay, so that means you need 2 years of 20% growth before those things come to a very normal. So there is a chance that probably some of these stocks become trading stocks for time being. So you buy at some lower level and sell at some higher level, and then make an exit and come back. So that's how we need to understand these particular stocks. Now let us say the same CDSL. Now so it's a huge declining bar this time, and it has gone probably we have seen the stock going below a 3-month low. So now we are, if you look at the stock and draw a channel. Okay, now what we are trying to do is we are trying to now this is the next level of support which comes closer to 1080, 1070, 1080, and next month probably it could be. So at 1100, 1130, probably at this point of time it can get support, because it would have dropped, it was a 1995 stock, and into 0.60 if you put it is 1195. So maybe at 1195 or 1190, 1190 where we show right now, probably around that level it can 1135, 1140, it can take some support. Now first come could be this, I think, which is around 1000 level. So I think probably this stock we have to see closer to that level before we go for a buy. Okay, and right now, so now this stock, if you look at it from the, it has fallen very heavily now. But if you look at the weekly chart, probably this particular area when it fell 1720. I think the 1720 must have been a very decent stop loss where we should have got out of the stock. 1720 is a place where we should have got out of the stock. Now, if it is going to rally from here, then in that case, since it has fallen here already to this level, the resistance will come closer to 1665 levels. 1665. So any rally to 1665 levels, it becomes a sell. So technically, we have seen that since the stock is fundamentally highly valued for the recent drop in momentum in the profit growth, this stock when it goes up, probably any long which you have already got, okay, probably you can sell it off at around 1665, wait for it to drop again, and then you can go for a buy. So that's how normally, and then wait for 1135, 1140. So if there is a sharp pullback can come easily, because markets always can look at new things and do that. So let's see. So that's how you look at the fundamentals, whether it is valued high, depending on its profit growth, and then look at the chart and then decide whether we should look towards being on the long side or short side of the market. And at this particular juncture, even this particular stock we have seen post pandemic. I think probably we look at the from the pandemic low. Okay, so this is the March 2024. So So pandemic and all, it was just around 90. So there's nothing much, the stock was nothing almost around the pandemic time. From 90, it has moved up so significantly to around 2000 levels. So probably now next level of support could come closer to the stock, 1120. This is what we said. So the stock which is now poised to 1120, and the higher level could be 1664. 1664, and this stock on a monthly basis looks to be 208. So anything 208 means around 700. So anything below 1298 or 1300, chances that it will definitely bounce back from that level. So I think the stock is definitely worth buying in the next few months around 1100, 1110, to see that you will make a decent profit before the end of this year. So that's how you blend both the fundamentals and technicals. So we will carry forward the discussion again. So if you have any questions now, please ask. Thank you. Okay, thanks for participation. We will see again on Thursday. Thank you very much.